Hi, this is Sean Jones from Jones Fiduciary Wealth Management and Jones Real Estate Access. And today I'm going to share with you 4 principles of investing in real estate. These are the principles that I did not adhere to when I first started investing in real estate 20 years ago, but they are the principles that have led to us being able to achieve greater than 20% average annual returns in our real estate funds. If you stick to these fundamentals, you're likely to have a experience that is much better than the experience that I um, lived through, we'll say, when I was 23 years old. The first thing that you should avoid in real estate investing is speculation on price appreciation. Now, this probably goes without saying, but it's very tempting to assume that there's going to be some amount of appreciation. People like to be right. They like to be able to know the future. They like to be able to look back and say, I told you so. But buying a property based on speculation is a recipe for disaster. Yes, if you assume that is going to sell for the exact price that real estate similar to that is selling for now, then it really limits the amount of real estate that is available. Real estate's not perfectly efficient, but it is efficient enough to where it makes it not so obvious which buildings are undervalued, let's say. And so the first thing is eliminate speculation. Secondly, we want to have modest debt on anything that we do. And sometimes, if it is a certain type of project, we want to have no debt at all. I would leave it up to the professionals to figure out what is modest debt and what is the appropriate amount of debt. And that's a good segue into our third fundamental, which is we want to leverage professional management. Now, all of my mistakes when I was younger were really fell upon because I thought I was going to build my own empire in real estate. And while I still believe I could have done that, it would have taken me so long and it would have been so expensive to learn how to do it that I would have had to quit my full-time job. For most of my clients and most of our investors in these real estate funds, their greatest asset is the job they have, is the career they've chosen. And that's what's led them to have extra money to invest in real estate. And so what we really need is for this real estate to be passive. Professional management will do a few things. For one, they're going to understand where the trends are in the market altogether. And so obviously, many people know that commercial real estate is suffering right now. But what you don't know is it's pretty much relegated to one major part of commercial real estate, or a couple major parts of commercial real estate. Office buildings are suffering right now. And most people think that, and if you read the papers, it'll just say commercial real estate suffers. However, there are many places in commercial real estate that are doing very well, namely multifamily rental properties. Also, data centers are doing quite well right now. Industrial is doing quite well right now. So if you're a professional in the real estate environment, a professional investor, then you're going to understand where those trends are. Then you're going to look into those trends, right? Because an office building in Atlanta is different than an office building in, say, King of Prussia. A data center in, the middle of America is going to be different than a data center in one of the major metropolitan areas. We're going to want to look at traffic counts. We're going to want to look at trends in certain cities. Where are people leaving? Where are people moving to? And so understanding those trends is really quite difficult to stay on top of them if it's not something you're doing every single day. So relying on professional evaluation is really key to having a long, successful career where there is not a super steep learning curve that you have to pay a lot in the form of losses to jump up that learning curve. You'll notice that the first three key points that I've covered here pretty much will eliminate things like flipping houses, giving money to your brother-in-law, giving money to someone that has a great business idea to accumulate a certain amount of properties. Means all of that is going to be very difficult to avoid losses, especially early on, before you figure out, really how to structure those deals. And so the last key point here is that when you do choose these professionals that are managing these properties, we need them to have enough skin in the game. And I like to invest in deals where the sponsors or the general partner of the deal has their own money in the deal. I would say at least 5%, but ideally 10% of their own money in this deal. That way, if you lose money and they lose money. Now, typically what will happen is you also want it structured so that they lose money first. In other words, if the deal is only going to earn $7 million instead of $10 million, they're going to take that $3 million loss on the chin, and we're still going to get our preferred return. And so the first way for them to have enough skin in the game is to invest their own money. The second way is that they would be subordinating their fees and profits to our profits, at least to the preferred return. What that means is that they are not going to make any profit until they give us our preferred return. And so if there's losses off the top end, that's going to come off of our return last. We are likely to get our return, or I guess much more likely to get our return. And so look at how does that translate into what's happening right now? As we said, office buildings are really doing quite poorly, and they're expected to do poorly over the next year and a half. Data centers are expected to do quite well because we have a couple things happening, most of which is AI, artificial intelligence. The computing power needed on artificial intelligence is just almost unfathomable, and that is going to require a lot of data centers. Multifamily housing, or just housing in general, there is a huge shortage in supply in housing. Right now, it's somewhere between 3.5 to 8 million units. That is expected to increase every year so that the total shortage is 30 million units between now and 2030. So single family housing is one of the things we've invested in. Right now, we've got one deal in single family housing that gives us a 12.33% preferred return. It will pay us 6.33% dividends on a monthly basis straight from the very first month. And we're expecting that total return to be somewhere around 15, but there's definitely some upside above that. And so that is on the multifamily housing deals that we are doing in the Southeast. I mentioned data centers. We are looking at a data center fund. Actually, we've invested in a data center fund with the same thing, 12.63 preferred return, 6.63 cash flow straight from the beginning. And we are not counting on a speculation in any of these deals. This is based on the idea that the pricing in these buildings and these asset classes is not going to get any better than it is today, even though we're pretty sure that because of my previous comments about artificial intelligence, data centers are likely to appreciate. And we will get 80% of that profit above and beyond the 12.63% preferred return that is being paid out to investors in that deal. Lastly, we've got a deal that is more of a lending, and that is meant to take advantage of local deals where the investors have a really good asset in place. They have a loan that is a performing loan, and it's just that the banking regulations are making it so that they're not able to refinance that and continue owning that without a lot of pain in terms of having to put more money down or whatever the case may be. One example, we were able to achieve an 18% preferred return, which pays 10% cash flow. Now that is on a storage unit that has been 99% leased for over 10 years now. And so we're able to come in and provide equity financing, and we're going to get 10% cash flow, and we are going to get paid 18% total equity before the sponsors of that deal are going to make any profit. And so it's been 99% leased. It's probably going to remain highly leased, and we like that deal a lot. So those are a few examples of how applying the fundamentals are going to help you to achieve the results you want in real estate without much pain involved. If you want more information, click the link below and you can learn more about our real estate funds. Or if you want to ask me any questions, go ahead and reply to this email.